Hey everyone, it's Rich Warner from wealthmaxbuilder.com. This video is part of the Basics of Investing video series, a series of tutorials on fundamentals of investing. And today's lesson is entitled How Time Horizon Affects Your Asset Allocation. What is time horizon? Why should we be mindful of it? And how that affects your investments across asset classes and funds inside of your investment portfolios, whether it be for saving for college, saving for a big ticket item, or saving for retirement, for example. So let's get into it. There are many factors that affect your asset allocation, how you're investing across funds inside of your overall investment portfolio mix. One of the biggest ones, if not arguably the biggest one that should affect the way you diversify your investments in a portfolio is time horizon. Other things that affect your asset allocation may include your projected expenses. Let's say later on during retirement, is that expected to increase significantly over time with inflation or due to medical expenses and such? The number of dependents that you have in your family at that time, your net worth at that time projected into the future. Will you have enough assets to rely on as a buffer in case things go wrong and you need to liquidate to help pay for expenses and things like that? Or scaling down from a larger house into a more reasonably sized home during retirement? What are you going to do with the money that is residual or left over from the sale of a bigger house and you're scaling down to a smaller house, for example? Other things that can affect your asset allocation include stock market valuation. For example, are we dealing with a stock market that is way overvalued as we are currently, for example? This being the fall of 2018, for example, we are looking at PE levels in the stock market that are exceeding 30 times earnings. So that's actually quite high. There are other valuation yardsticks. I won't get into that now. That suggests that the current stock market is quite overvalued. So that should affect the way we invest across stocks and bonds. The directional trend of the stock market, for example, which is much harder to pinpoint for the average investor or to take advantage of. And I've actually designed a spreadsheet that takes all these variables into consideration to help you determine how much you should be allocating to the stock market relative to the bond market, or to stock funds relative to bond funds. I call it the ultimate asset allocator, and it actually takes time horizon into account, your projected net worth, projected expenses, the market valuation, and the trend of the market. And as you can see, all of these variables have certain weightings. But the most significant here on this list is time horizon. So we need to get a pretty good understanding as to what time horizon is and how it affects our asset allocations. Okay, an investor's time horizon is really tailored to the target date for a particular financial goal. So let's say if you're saving for a child's education and you start saving around the time the child is born, you have about 18 perhaps more years to save for college or some vocational program for your child. So your time horizon in this case is 18 years. But let's say you're in your 20s and you're planning to retire around age 67, 65, 67, 70, somewhere around there. Well, if you're in your mid-20s, then you have about 50 years to go until you retire. So your target date in that case would be about 50 some odd years. That means your time horizon in that case, saving for retirement for young people, usually implies long time horizons. Whereas if you start saving for your retirement in your 40s, you only have, let's say, 15 years to go to retirement. So your time horizon is much shorter. In another situation, you may be saving up for the down payment of a home in a few years. Let's say you're planning to put a down payment in about 5 years' time from now, and you and your significant other are going to be plunking down maybe $100 a month or a couple $100 a month towards the down payment of a big ticket item like a home or a car. Well, then your target horizon, let's say, until you decide to buy the home, may be 4 or 5 years from now. So your time horizons will shift and differ according to your target dates as to when you're going to start needing the money to make a purchase, or in the case of retirement, when you start to liquidate and draw down from your retirement fund in order to help pay for living expenses. So it's quite possible that an individual or household may have multiple time horizons for different financial goals. When it comes to investing, the longer the time horizon you have, the more aggressive you can afford to be as far as the overall asset allocation or mix between stock funds and bond funds is concerned. Conversely, the shorter time horizon that you have to meet a particular financial target date, the more conservative you should be about your overall asset allocation. And the main reason for this has to do with the ability of the stock market to rebound from potential serious drawdowns. How long is it going to take for you to recoup your losses in your portfolio from a stock market peak to a trough? That is a significant question when it comes to the way we spread our risk across our investment portfolios. Here's a graphic representation of what I just spoke about. Basically, the more time that you have to invest or to meet a target date, the longer your time horizon, the riskier you can afford to be, i.e., the more allocation you can afford to have to the stock market in stock funds, whether it be U.S. stocks, international stocks, etc., emerging market stocks, technology companies, what have you. The less time that you have to invest, the more conservative your asset allocation should be. The safer investments you should have, i.e., investment-grade bond funds. Let's explore in greater detail why this is so. If we look at a long-term chart such as this of the Dow Jones Industrial Average, say, or the S&P 500, you'll notice that way back in time, as well as in the recent past, we've had some significant market spills, some bear markets, the worst being in the Great Depression, where stocks actually fell from a peak in 1928 by a cumulative drawdown of negative 85% between 1928 and 1932, a 4-year period. We saw the stock market fall by about 85% in value. That's quite significant. So that means if you had the unfortunate experience of purchasing $100,000 of stocks in 1928 at the peak, it would have only been worth $15,000 by 1932. And that's quite a significant drawdown. Now, how long did it take to recoup this loss in the stock market? And as we see in time, there have been other market spills, not nearly as significant as in the Great Depression years, but still quite significant enough pullbacks to delay the growth of the stock market, so to speak. In the early 1900s, for example, it would have taken 19 years to recoup the highs from the early 1900s. In the Great Depression years, it would have taken about 25 years to get back to break even. During the late 1960s, as the United States experienced the Vietnam War era and inflation increased dramatically into the early 70s, we had a period of market stagnation where it would have taken 16 years for you to see any growth whatsoever based on investing in the stocks that comprise the Dow Jones Industrial Average. And if we look at the recent past, the pullback years from the tech bubble burst of 2000, the Dow Jones doesn't particularly show this as well as the S&P 500 and the technology index, but anywhere from 6 to 10 years is what it took for the markets to recoup their losses from the early tech bubble burst and then the drawdown that we experienced in 2008. And here's another chart of the S&P 500 from 1871 to the present that shows all these pullbacks in the markets along the way. So bear markets are just part of the deal. You can't invest in the stock market, and this goes for any stock market, by the way, of any global stock market, whether it be Europe, emerging markets, technology, what have you. All stocks have these bear market pullback periods. And as we've seen, some recovery periods take longer than others. And a recent study that I did of these bear market periods in real terms shows that the average number of years to recoup a bear market pullback period is about 10 years or so. If we take an average of these going back even further, including the early 1900s, the average pullback then increases from 10 to 15 years. So we're looking at about 10 to 15 years, let's call it 15 years to be on the safe side, that it's going to take investors to recoup losses from bear market periods. And as we can see from this chart, we'll notice that the pullbacks can be significant. In this case, a pullback of 70% in the early 1900s. The Great Depression, as we mentioned, a pullback of 80%. And then in the 60s, early 70s, we had a pullback period of 63%. And then more recently, we've had pullbacks of 50% or so from the tech bubble burst as well as in 2008. So the pullbacks can be significant. And mathematically speaking, let's look at what it means to have pullbacks of certain percentage magnitudes. This is basically a table where I'm trying to show you, based on actual mathematics, not speculation or market tendencies, what percentage gains do you need to recoup drawdowns of, on the left-hand side, for example, we've had the drawdown of 10%, for example. You would need about an 11% return to get back to break even. If you suffer greater drawdowns of, let's say, 33%, you'll need a 50% rebound to get back to break even. Similarly, if you have a 50% breakdown, you'll need a 100% rebound to get back to break even. Let me show you another graphic representation of this. In some of my courses, I ask students, how much of a percentage rebound do you need to get back to break even if you lose $50 on a $100 investment? So I think everyone would agree that if your investment drops from $100 to $50, you have a pullback or drawdown of 50%. But how much do we need to get back to 100? Well, there's the rub. Most people take a look at the percentage drawdown and they think, oh, it's the same amount that we need to get back to break even. But that is in fact incorrect. If we had a 50% recoup on $50, which is where we are currently at this point, that'll only take us back up to 75, not 100. Pure mathematics here, no smoke and mirrors. We need a 100% return to get back to break even, not 50%. And this is what this table is actually showing as well. God forbid we get another pullback as we did in the Great Depression years of greater than 75%. Well, you would need returns in excess of 300% to get back to break even if we suffered pullbacks of that nature again. Now, in terms of the actual number of years to get back to square one for investors who suffer large pullbacks in their portfolio, we're looking at 9, 14, 20 years in some cases. In the severest cases during the Great Depression, as we saw, it took about 25 years to get back to break even. In the more recent past, we've shown that to get back to break even, you'll need somewhere between 10 and 15 years. So let's call it 15 years for most investors. I think that's a pretty safe assumption to make, especially since we'll be having more conservative asset allocations that include investment-grade bond funds in the mix and not just stocks. And I like to just remind ourselves of the benefits of a proper asset allocation where you have allocation to investment-grade bond funds. As we've seen in the recent financial meltdown years of 2008 and early 2009, stock market pulled back by over 50%, and yet Treasury bonds were there to help buffer some of that pain and to balance things out, if you will. So keep in mind that a proper asset allocation and diversification across the major asset classes, particularly by investing in investment-grade bond funds, you will help buffer and reduce the volatility and risk from a stock market that is going down severely. But this notion of pullback time to recoup losses from severe bear markets or from market spills is extremely important for seniors. Not as much for younger investors because of the number of years potentially that it could take to rebound from stock market losses. If you are a younger investor, let's say with 30 years to go till retirement, obviously you have two 15-year periods inside of 30 years to recoup potential stock market losses. So you can afford to be invested or more allocated to the stock market. But let's take the case of a senior who has just entered retirement, age 65 or 67, and they experience a huge bear market early on in their retirement. This is the worst case scenario for them. Because remember that when you hit retirement age, you're starting to make withdrawals from your retirement portfolio to help pay for living expenses. During retirement, you no longer have earnings income. You're principally relying on your Social Security benefits as well as your retirement nest egg to help pay for your living expenses. Well, now that the stock market has essentially pulled back significantly, assuming that we've just experienced a bear market or we're in the making of a bear market in your early retirement years, you will have a lot less equity value in your account to make withdrawals. And the double whammy is that unlike young investors who are not taking withdrawals from their retirement accounts and in fact are making additional contributions every month, every year, and this process of making additional contributions along the way assumes that you're investing in your dollar cost averaging, which means as the market is going down, you're buying more stocks along the way for cheaper and cheaper prices, which actually helps your average cost of entry. Your entry cost is actually averaging down as your dollar cost averaging in a bear market. Contrast that, the senior who is taking withdrawals from the retirement account is not making additional contributions and is doing the reverse. So you're making withdrawals from a portfolio that is withering and it's actually diminishing in size, and you're not restoring or making additional contributions along the way. So now if the stock market turns and recoups, there is less money in the pot to recoup with. And so that is the reason why seniors face a potentially dangerous situation where they'll be making withdrawals every month from their retirement portfolios. And it could very well be the case, if they weren't properly diversified across stocks and bonds, that they will use up all the capital in their retirement fund before they pass away. Here's a calculator that you can access online. It's called lifeandmyfinances.com. And you can actually project how long your retirement money will last, assuming certain parameters that you input. You input your current age, your retirement age, how much you have in your retirement nest egg, whether there'll be additional monthly investment contributions or not, and your total monthly living expenses. Assuming that you have living expenses of $3,000 in this case, and you've been making $1,400 a month contributions, your investment portfolio could last a certain number of years. But if we're no longer making those contributions and we have those monthly living expenses, we're going to draw this down sooner than later, and we may not have enough to live on for the later years of your life. There's another retirement calculator that you can access if you go to nerdwallet.com, and it will help project whether or not you will have enough buffer in your retirement portfolio to help pay for living expenses during retirement. Now, keep in mind that one of the potential dangers that we face as far as time is concerned is that inflation is with us most of the time. And the average annual rate of inflation in the United States is about 3% a year, which means that the buying power of your dollar is decreasing by 3 pennies per year on average. And what this means is that your projected living expenses, let's say they're $40,000 today. Well, if we assume a 3% inflation rate, which is the orange line here, that means that in 30 years from now, we're at $93,000 a year. So what was $40,000 in living expenses today will be somewhere around $93,000 30 years from now. So what this tells us is that we have to invest our funds properly today. We have to beat the rate of inflation. That is our bogey. We have to generate real growth in our investment portfolios. And that means basically that we have to be invested to stocks, because stocks are the principal ways over time to beat inflation. Investment grade bonds will give you maybe 1%, 2% a year in real growth, but the stock market can give you about 6, 8, 9% a year in growth. So we have to be exposed to stocks at younger ages. But the issue here is that because we're drawing down the portfolio during retirement years, as we approach retirement age, we have to get more conservative with our asset allocation. That means less exposure, less allocation to stock funds, and more to investment-grade bond funds. So the fact that inflation is eating away at the purchasing power of our dollar. And inflation is an issue for most countries in the world. Most countries experience inflation. In some cases, they're really, really exorbitant, in which case they should be invested for the long haul in dollars or in euros, for that matter. But that's a whole other issue. For dollar-based investors, the rate of inflation is about 3% a year. And to beat that, we have to generate real growth. And as you can see, if we're invested at 8% for 40 years, your growth in your portfolio over long periods of time will become exponential due to the power of compounding over time. This is related to the future value formula. In a previous video, I talk about future value and the power of compound growth. And the key takeaway from that video is that we have to get the snowball moving as early as possible. The earlier you start investing in your retirement Roth IRA and take advantage of growth over long periods of time, this T refers to the number of years invested in your retirement portfolio. The more years you are investing, the more growth you'll experience, especially in later years. In a previous video, I talk about my Gilbert Millionaire spreadsheet, and you can access this spreadsheet under the video description as well as on the wealthmaxbuilder.com website. I basically prove to my readers and viewers that, if you stick with a consistent investment strategy and you're plunking down 10 to 15% of your earnings into a Roth IRA, over time, it's not impossible for you to generate a total portfolio end value that exceeds $1 million. As a reminder, I also showed you that the earlier you start investing, the better. In the case of Martha, she started investing early and only contributed about $16.8 thousand or $17,000 into her Roth IRA at 8% growth. George started much later, and he contributed over $63,000, but they both ended up with the same portfolio end value. This is because Martha had a higher T value. The growth rate was the same. Principal value was actually greater in George's case, and they had the same growth rate. The principal is growing over time. More contributions you make into your investment portfolio, the greater this number becomes, and it's not a constant in this case, but Martha contributed about $17,000. George contributes over $63,000, but because Martha has a much higher T value, they both end up with the same amount of money, which is about $280,000. That's why starting early to save your retirement portfolio is such a big deal. But I think the key takeaway from this lesson has to be that bear markets do happen on a periodic basis. It's something that's just part of the game. And to prepare seniors for this possibility that it can occur early on during their retirement years without giving them the chance to recoup their losses. This means that the older you get and the less time that you have, the shorter the time horizon, you must downshift your asset allocation from a more aggressive model to something much more conservative. And the principal way you do that is by lowering your allocation, your percentage weighting to the stock funds in your asset allocation mix and raise the investment grade bond fund allocation proportionally. So to summarize, the key takeaways from this lesson are that recovery time is especially a big issue for seniors. Young investors have a lot more time to recoup from bear market periods and losses in the stock market. Seniors also take distributions from their retirement accounts, so a bear market in early retirement is a double whammy, denying seniors the opportunity to recoup losses fully. So the threat of depleting retirement assets is real for seniors who start saving late especially, or who are overly exposed to the stock market. Time can work for us if we harness the power of compound growth early on in our working careers, but it can also work against us in the form of inflation. More years of inflation means less buying power going into retirement. If we assume a 3% rate of inflation over time, a $40,000 living expense on an annual basis will amount to over $90,000 30 years from now. We have to plan for that by allocating essentially more of our portfolio to stocks. The way to combat inflation is to harness the power of compound growth inside of a tax-free account like the Roth IRA while investing in stock funds that beat inflation. Now, you don't have to be overweight stock funds, but you have to have a significant allocation to stocks during your younger years. Another way to beat inflation over time is through real estate, but we'll save real estate investing for other courses. Time is money, or rather, time can make money. The earlier you start saving, the better. This is a mathematical truth based on the power of compound growth, which is essentially the future value formula, as we've seen. If you'd like to know more about how to actually divvy up your portfolio in greater detail, I will be talking about that in other videos as part of the Basics of Investing course. Well, that's it for this lesson. I hope you enjoyed it, and I look forward to seeing you in the next lesson. Thanks for watching.
Mm-hmm.